Hello and welcome to the Case chat session on December 17th, 2014. My name is Dean Rogers and I'm the Senior Analyst at Case & Company. And like normal, this is any kind of consulting, advice, recommendations. All we're really trying to do here is educate people on how we look at markets, how we make decisions about markets, and how we analyze markets so that you can use those techniques and that information to help yourself make better trading decisions. Today we're going to go through trade setups and targets and some very interesting formations on the E-mini S&P 500, something that we've been looking at for quite some time. E-mini has been down, declining, and it looks to me like it's going to continue to decline, probably down to a 1909.30 target. That's going to be the key decision point. If it breaks that, very good chance that it will test its 1813 swing low that was made a few months ago. But the 1909.30 potential stalling point, I do think that we will test it just based upon some of the wave formations. So we're going to talk about that. We're also going to talk about the hot topic of WTI crude oil. WTI is not something that I cover a lot in these chat sessions because it's something that it's our specialty area, it's our expertise area, and we have a lot of services, a weekly newsletter, and a commentary that we send out to clients on WTI. So I talk about WTI from time to time. I want to talk a little bit about it today and how $50 is a major target that I really like. And overall, I'm looking for longer term, probably a trading range between somewhere between 65 and 80, maybe even 65 and 75 for the most part. But I do think that we'll get an overreaction here soon. It's not like we're going to be at $100 again here in the short term. But, over the next couple of weeks, months, once a bottom is made, we'll probably see a 2, 3, maybe 4-month move higher back towards $80 or so. And then as usual, you can always get a hold of me if you have any questions, any issues you want me to cover, or securities that you want me to talk about in these analyses. You can get a hold of us on Twitter at Caseco, or you can email me directly, dean@caseco.com. You can also reach us through our websites, casestatware.com and caseco.com. You can even get in touch with me directly on StockTwits. My handle is pdeanrogers, like Paul Dean Rogers. On our websites, we also post our blog, these weekly chats. So with that, we're going to go ahead and share out our screen, and we'll get started with the analysis.
So the first market that we're going to look at, let's look at the E-mini S&P 500 because it's the one that we've been following for the past few weeks. We've been calling for a correction. Initially, it was a market that, we weren't real certain whether it was going to be able to move down, significantly or not. So far, the move down has been pretty good. If we look at the move up from 1813, which is the last major swing low, up to the 2079 swing high, I'm drawing these in very roughly. You're looking at right now right around a 38% retracement. Now, generally speaking, a 38% retracement is a normal correction. So in a lot of cases, whenever you see a 38% retracement, that is generally indicating that there was profit taking, maybe some short-term speculators pushing the market down with short positions. But overall, it's nothing to get too excited about. We have been just below that, but we haven't closed below that 38% retracement. That 1977 is an area that we've been talking about for a few weeks because of that fact. The next major target that we're going to really want to watch is going to be right around this 1913, the 62% retracement. It's actually, I think, my confluence point is right around 1909. So that's an area that we're really going to want to watch, because if the market takes out the 62% retracement, this move up is really no longer corrective. We're now establishing a downward trend, at least for the near term. We're not talking about a major downtrend, but it could be something that turns into more of a decline, more of an extended correction, and could move down to challenge the 1813 low. And really one of the things that this market has been lacking over the past several years, when we look at a weekly chart, the major swing lows are not getting taken out. You can see that for the most part, the only time that we really took out any of the previous major swing lows were on these early declines from 1216 and 1373. And when we've been watching this from 665, this is what we've been calling wave 1, or A, B, and then C, because this formation here, or 3, this formation met its intermediate target up here towards the 2079 swing high. So if this ends up being a 5-wave formation, we should be getting a wave 4 here. We could get the wave 4 at the 1.618 projection, which is a little higher. So, but nonetheless, good chance that we could see a significant correction. And one of the things that we've been missing all along since this 1068 swing low is the major swing lows have been holding. And that's one of the things that define a trend, higher swing highs and higher swing lows. So this has definitely been a bullish market, but a key aspect is if we can take out this 1813, I'm not calling for that. I don't think we're going to see that a move that low at this point. But, getting back to what we were looking at before on that daily chart, if it takes out that 62% retracement right around that 1909 area, the confluence point, then, there's a legitimate shot at that point that this 1813 swing low could be challenged. So with all of that said, let's actually look at another reason that I think we're going to get a test of this 1909 area. I'm going to switch back to my Kase bar chart. I'm using a 10-point Kase bar chart this morning just because I want to look at some of the bigger waves. Now, whenever I'm looking at waves and wave formations, one of the key things to do is determine what are your major waves. Generally speaking, your most important waves are going to have the biggest corrections. Okay, so the distance between your YZ points. So if we're looking at this just as review, if we're looking at this move down from 2079, this 2079 is going to be your X, 2033 is going to be your Y, and 2060 is going to be your Z. So the waves with the biggest YZ portion is, or generally speaking, not always, but generally speaking, is going to be your primary wave. And one of the reasons I really think this market's going to probably continue to move down is that right now our biggest correction is from this 1968 to 2018. That means that more than likely this entire move down is forming a wave A and then B, and then we should get a C lower. And right now, this morning, yes, we're up a little bit, but that looks like a corrective pattern to me, consolidation, kind of like we saw right in here, before it's going to try to break to the downside again. Now, if it takes out this 2018 swing high, the story changes somewhat. But for right now, it looks to me like the 2079, 1968, 2018 is going to be our key wave A, and the subwave of that is going to probably be the second biggest correction, which is from 2023 to the 2056. Now, what's interesting about that wave is, I'm just going to draw it in here before I show you guys my spreadsheet, is we met the 1.618, or the larger than target, right around 1965, 1966, right at this 1968.25. Remember, we usually, not always, it depends on your depth of analysis, but we use about a plus or minus 5-point range. So, as long as we're within 5 points of that 1965 and the 1968, we can consider that that larger than target was met. So this is a good stalling point for the market, but what it tells me is we have one of two things going on. We're either going to get this as a wave 1, 2, 3, 4, and then 5 down, or this is going to be an ABC, a 3-wave correction, A all the way down to the 1968, B back up to 2018, C all the way down to at least the equal to target, well, at least a smaller than, but usually the equal to target. And then this would be a subwave A, B, C, and then you'd have a subwave A, B, C here, and another subwave A, B, C. So you could have a very complex nested ABC formation, which is pretty common for corrective patterns. So that's more than likely the case. But if we look in both situations, if we start to look at our breakdown and we look at our waves, okay, I spent some time working on this morning, and one of the things that you can see here, the really interesting thing, is first off, if we look at that 2079 to 2023, okay, so this was either wave 1 or it's A prime of A, okay? So this is, and then this is wave A, which is the 2079 all the way down to the 1968, all right? So if we're looking at that, the key aspect, if you look here, the move down should extend to at least the smaller than target of wave A, okay, if it's going to be a three-wave formation. That's going to bring us down to right around 1950. My confluence point is right around 1954, just because that ends up being, it can get some more fines by combining it with some of these other wave formations or projections. But then once you meet the smaller than target, generally speaking, you're going to extend to the equal to target, which is 1907. If we look at about a plus or minus 7-point range, okay, we expand our range a little bit, we can look at the difference between 1916 and this 1907.30. That gives us right around 1911 or so. I'm sorry, actually we want to look here between these two because this is lower, the 1916 and 1902. So that's going to be our 1909.3, which is our target here, 1909.3. All right, so that's our trend terminus next C for the 5-wave formation. So if this ends up being wave 1, 2, 3, 4, and then we get a wave 5 should bring us down. Oops, sorry, that's my WTI. Wave 5 should bring us down to that 1909.30. That's the midpoint between the trend terminus and the XC. The trend terminus and XC are usually the lowest that wave 5 goes. The key aspect to this is that's also the equal to target of the potential wave A. So if this entire move down ends up being wave A, B, and then C, and we meet that smaller than target right here, right around 1954, and take that out, we should see a move down to at least the 1909. So at this point, we can make a good determination. This is the idea. This is the whole idea behind confluence. And it's going to get even better. All right. So far we've got a really good example. But what we can see so far is, first off, as long as this the 2018 swing high holds, we should be able to see a move down to at least 1954. If it takes out 1954, which I think it will, because generally speaking, when you meet the smaller than target for a wave, you extend to the equal to, we should see a move down to 1909. 1909 is the key decision point because it's the lowest that wave 1 or A prime of A projects. It's the equal to target for wave A. And most importantly, it's the 62% retracement for the move up from 1813 all the way to the 2079. So 1813 to 2079, the 62% retracement is right around our 1909 plus or minus 7 points. In this case, you could even say it's plus or minus 5 points. All right, so as a trader, okay, so as an analyst, I'm very confident that we're going to see this move down to 1909 as long as that the 2018 holds. If 2018 holds, all bets are off. Really, at that point, we're probably going to see a move, or another attempt to move back up towards the at least the 2056 swing high, and maybe even 2079. But for the most part, we'll get into resistance a little bit more here in a moment. Right now, I really firmly, as an analyst, think that there are high odds, I would say probably in the 70 to 80% range over the next few weeks, 2 to 3 weeks, that we're going to see this 1909.40 area. Now, at that point, as a trader, market drops to 1909. What I'm going to be really looking for are signs of life, signs that this market may turn higher. And I'm really going to want to look for that on intraday charts, see bullish divergences, and we can drop into even lower bar lengths, time a long entry, and then begin to scale those back up to the longer bar lengths as we get the confirming signals. However, if it takes out, we could just get a correction, and if it takes out that 1909, I'm fairly confident that we'll at least get an upward correction at the 1909. But if it can't hold the 1909 area and it takes that out, you're really looking at a situation where you're going to start to see an extended correction down towards the next targets, which are right around 1865, 1838, which is the last level protecting the 1813 swing low. Okay, both of these targets are the 78 and 89% retracements up from 1813. So you can see the confluence and the connection from 1954 to the 1909 to the 1865 to the 1840 area, and then from there potentially down into this 1764 and maybe even 1712. Okay, so that's what I'm saying. If it takes out 1909, it's more than likely, because usually you're going to get an extension from the equal to the larger than. The intermediate is called the intermediate because it's an intermediate target. It's not as important as the equal to and the larger than. So if it takes out the larger than, takes out that 1813, then you're looking at a move down longer term towards these targets. All right. So we've got some very good indications of what's going to happen right now on the downside. On the upside, really what we're going to want to look at, the one wave up that we have right now, or the two waves up that we have right now that actually mean something, are from 1968 and the 1969. Okay, 1968 and the 1969-25 swing lows. And your first resistance is going to be right around 2000. Okay, the smaller than target from the wave up from 1968 and the intermediate target from 1969. If it's able to overcome that, we should see an extension back up towards, somewhere right around this 2022 or so, which is the equal to target for the bigger wave up and the trend terminus and XC. So kind of same connection, equal to, and then trend terminus XC. If it breaks above that, you're going to see the 2049, right around that area. That's the larger than. The important part about that is it's also the intermediate, the smaller than target for this wave up from 1959 to the 2079, which was, if we look at our intraday chart here, here's the 1959. Okay, so the one wave that really counted on this move up from 1813 was 1813, 1985, 75, 1959. That's because that was the biggest correction up until the point that we got the 2079 move down. So the smaller than target up from 1959 is going to be, again, in line with that 2045, 2046 is the larger than target here for the one wave up from 1968, and then you've got the smaller than. Then you can make a connection to a new high right around 2114 or so. All right, but right now we're going to really want to watch to see whether or not this market's going to continue to move down as expected, meet this 1909. It may chop around a little bit. We've got the holiday week next week, New Year the following week. Trading may get a little weird. So we're going to have to watch it closely. This is the time of year where you kind of have to watch things really closely. But just from a purely technical standpoint, reading the charts, this is what we're seeing. All right. Let's talk for a few minutes. I'm not going to do a lot on crude oil. Crude oil is one of our primary products. If you're interested in our full analysis of crude oil, please let me know. You can email me, dean@caseco.com. Be more than happy to send you a copy of our weekly newsletter. The crude oil market right now is it's pretty crazy. Okay, we took out the 62% retracement of the move up from 32.40 to 114.83 when prices fell below the 63.90 area a few weeks ago, about 2 weeks ago. Once it did that, you're really looking at a move down towards 50, which is a 78% retracement, 50.5. Okay, 50 is a number I've been in love with for a very long time. All right, and when I say very long time, it's all relative. Okay, for about the past 2 months. I have really liked the $50 area, maybe a little less than that, maybe about 6 weeks. We had been looking at, once the market broke this 73.50 area or 73.40 area, that was a big confluence point, very important, just below the 74.95 previous swing low. It was the last, level protecting the 63.90, which was really probably the most important point because it's also in line with the swing low of 64.24. What I've been trying to do is show people where, and show our clients in our newsletter where the potential selling points are. And more importantly, on a week-to-week basis, as the market drops and continues to move down, where the key resistance levels are going to be. Because one of the things that I can say, and you can see that on this chart, is crude oil overreacts. Energy commodities in general overreact one way or the other once they establish a dominant trend. We saw the same thing back when market ran up to 147, then it fell to 32.40, then rebounded to 114, then fell all the way to 75, and then just kind of like a spring, like a coil, like a rubber band, just went back and forth until it finally consolidated to a point that it broke out of that consolidation to the downside, and we're continuing to see this long-term move down. Okay, here's our consolidation. We broke out of that consolidation a little earlier this year, and we've continued to decline for the past 3-4 months. I really like the $50 area. That's a number that, for me, is not only a confluent support point for the perpetual or the continuation chart, which we're looking at here, but it's also a very important support point for the January, February, and March contracts, all of which are the first 3 nearby contracts right now. January will roll off and expire on Friday. February will become prompt. So I've been paying a lot of attention to that and what differences we're seeing, and the $50 area is confluent for all 3. So I really like this $50 area. We've also met some intermediate support here today or yesterday, right around this 53.60 low. It's an area that's reasonably confluent. We've got some consolidation. We could see this market oscillate a little bit before it makes its last push down towards 50. I truly believe that this market will spike higher once the low is made. There will be no capitulation. There will be no consolidation, in my opinion. That is generally the pattern that we see take place historically in commodities like crude oil and natural gas, which we watch, on a day-to-day basis and analyze on a day-to-day, minute-to-minute basis. So when this market does decide that a bottom has been made, I'm not saying we're going to be at 100 again in 3 weeks, but I do think that we will see an overreaction to the upside that takes place over a 2 to 3 month period, maybe 4-month period of time. As far as targets are concerned, let's look at the targets that I have here. Looking at support first, I've got the 49.87. We've got this 51.66 as an immediate support point. 49.87, that's my key level. If it breaks the 49.87 or $50 area on a sustained closing basis, I'm talking close a week below 50, a weekly bar below 50. Then we're going to probably see a move into the mid and maybe even towards the low, like this 43.80 would be my next big target, maybe 46, but the 43.80 is interesting because it is the smaller than target. It's the only valid wave projection from the 147.27 swing high that was made in 2008 down to 32.40 back up to 114.83. That's the 0.618 projection. The equal to is actually right at 0, and we know that crude oil is not going to go to 0. And then everything else is negative. So 43.80, if it breaks 50, that will become the next most likely potential stalling point for crude oil. We've also got some targets in here for some of the major waves, right around this 47.50 area that we looked at here, 47.50. That's another important point. So at this time, everything is important. Every number that these major waves project to. I'm not even looking at small waves at this point. I'm just looking at the major down waves. All of these levels are important. The $50 to me stands out to be the most important because it's the most confluent, not only on the perpetual, but also on January, February, and March contracts. As far as resistance is concerned, we do have this one wave up that gives us an idea of some intermediate or immediate resistance levels. But the best, and we finally have a little bit of stability today, so we can use the retracements, especially the retracements, the recent retracements down from some of these levels like 58.73, the 64.20, 66.89. But even going back to the 112.24 swing high, the 107.73, you can see some intermediate. Right now, in my opinion, the two most important levels are going to be at 65.50 and right around 73.80, $74. The reason that I say that is they are the 21 and 38% retracements from 112 and 107.73. Historically important swing highs, especially this 107.73, because that is the swing high that took place this year before the major decline. it's also the 38% retracement. So if you move above that, okay, we talked about normal corrections normally hold the 38% retracement. I know $74 is a long way away from where we are. But believe me, crude oil, once it starts moving, it can move very, very quickly. So $20 on a spike higher isn't going to take a lot of time. I'm not saying it's going to be a few days. It's going to take some time, but we're looking at a few weeks, maybe even a month or two. This market could be back up towards 74. When all said and done, I think a range between nominally 60, 65 and 75 is going to probably be the range that we'll settle into, with maybe some excursions down to 60 and up to 80 on little pushes higher and lower. All right, but these are the two numbers that I really like, 65.50 and 74. One of the other reasons I like them is because when we look at the candlesticks right now are a great way, the weekly and monthly candlesticks, when you get a big move down like this, are a great way to gauge where resistance are, because they're stable. Weekly and the weekly and monthly candlesticks aren't going to change other than for the current week or current month. So past weeks and past months are going to stay stable. The retracements, the challenge with the retracements right now is every day as new lows are being made, your retracements are changing. Albeit slightly, they are changing. So right now, I've been really watching when we look at, first off, the monthly chart. Okay. This month's important, but last month's more important because this month's continuing to change. Last month's midpoint and open are really important. Those levels right now, okay, so for month 0, which is this month, here's our 65.90, that's the open. The open is not going to change. So our 65.50, the 66 is the confirmation point. If we look at 65.50 plus or minus 50 cents, a little bit of a wider range than I normally use. I normally use a 35-cent range. The confirmation point, which is the open of the month, that's not going to change. That's stable. That's a level, an important level. That is also the open from a week ago, 65.50. It's also near, if we look 2 months ago, or two weeks ago, the 2 week ago bar is not important. But anyway, that's right around 65.90. Okay, but there's our 65.50. Okay, it's the open of last week and this month. All right. So if we look at last week's bar, we look at the weekly chart, week 1 and 3. So 0, 1, 2, 3. Week 1 and 3 are important. All right. So when we look at that, week 1, we've got the 61.60. That's our initial resistance. Pretty important right in that area. That's the midpoint of last week. I don't think we can get too excited about crude oil until we move above at least this 61-ish dollar area. 65.50. If we move above that, I'm pretty confident in saying at that point the move down is over. We will not see a new low at that point. And I know that's a ways away from where we are, but this has been an extremely big move, and we need a big move back to the upside before we can really firmly say that a bottom has been made. And then if we look back 3 weeks, there's our 71.40. That's the midpoint there. So much of this right now is hovering around the 65.50, and the 73.40 is the midpoint from a month ago. I'm looking at that 73.80-ish area as the long-term big resistance level. If we get above that, market might start to adopt a little bit more of a bullish tone for longer term. Again, I'm not expecting that's going to be the case. I think that we're going to see the market spike higher initially, probably overshoot this 73.80, maybe move back up towards 80 and come back down after it overreacts to the upside and start to form a consolidated range. And look, in crude oil, a $10 range is normal. That is really nothing. So a $10 to $15 range between 65 and 75, maybe even something like 65 and 80 would not be too outside the realm of normalcy with WTI for the longer term. So with that, we will wrap up for the day. Any questions, comments? We'll talk to you all again real soon. If you have any comments, questions, or concerns, please email them to me, dean@kase.com. Thank you very much and have a good day.